Alright guys, welcome back. Grab a pen and jot this down. Today we're going to quickly talk about the difference between hedge funds and mutual funds, talk about the performance fees associated. This is a topic that's always on my mind when it comes to investing capital. If you're not conscious about the fees and what's eating your balance, your cash balance at the end of the day, or your investment capital that's at work, this is something where the trade, meaning you're going to put money into the table and the manager, the fund manager, someone on the other side is going to do something for you in exchange for that money, and they're going to deliver some type of return back to you. The return doesn't have to be positive, nor does it have to be the best, nor does it even have to be the average. So your job is to filter out the bad ideas. So what happens is mutual funds, many index funds have very high management fees, meaning they're basically anything over 0.10, so a tenth of a percent, is a very high fee because the S&P 500, the money market index, the broad market index, by Vanguard or BlackRock, iShares, or any of the major ones that buy 500 shares provide you market index average returns at point tenth of a fee of what maybe a wealth manager will provide at 1% to manage your assets. A hedge fund manager will probably be in the 2% range, and everyone else is somewhere in between. So the question is, do you want to pay high fees, and what are you getting in exchange? Now, if the S&P 500, which includes every type of investment you could think of, healthcare facilities, real estate, e-commerce, technology, software, all types of manufacturing, industrial, consumer, food, restaurants, everything you could think about is in those 500 stocks. And you're going to pay pennies to have that managed, and you're going to earn a return probably over 10 years, somewhere roughly around 7-8%. That's the compounded return over that period of time. It's been happening for the last 100 years. So that's the market return. Ask yourself, what is a mutual fund manager doing if they're going to charge you, let's say, 0.75%, so 3/4 of 1% to, let's say, emerging markets, European tech stocks, fintech, specific types of industries, niches. You're going to have to ask yourself, why are you going to invest in those niches if the return is not greater than, let's say, 10% in this case? So if the S&P market is delivering 8%, then you have to add the spread, meaning you're going to subtract what the fee would be. And if you have a very high fee, 1% and above, you've increased your hurdle rate, meaning you have to generate at least 9% from an alternative investment. So if you're investing in the S&P 500 and 500 stocks, and you invest in, let's say, the banking ETF or mutual fund, which might be 75 stocks, might include all the major banks, some maybe private equity, commercial banking, investment banking, universal banking, etc. That specific niche has to perform at least 9% to be worth the additional costs and management fees. And in most cases, it's not. It's probably average at best. Sometimes 1 or 2 years it might be really well. Other times it might just be underperforming. Whatever the case might be, it's just not going to be any much better over a long period of time unless you have a very good idea. You're buying banking stocks at the bottom of the recession, at the bottom of the financial crisis. Maybe you're buying energy stocks at that period of time as well. So it doesn't matter what you're going to do, but you have to kind of have that level of foresight or level of active investing. So you'd be like, all right, this is where the investment is, and this is where the investment is going to be, and I'm going to make an outsized return, maybe 15 to 20%. Not common. You'll also find that mutual fund managers don't do a good job of doing this, and most of their jobs have been replaced by computers that just perform at a lower fee ratio. So that's the number one thing you need to focus on when you're thinking about investing in these funds, ETFs, indices. What's the fee structure? And that's only management fees. The reason people pay 2% for a hedge fund manager or a private equity manager or a real estate manager is, hey, you're going to actively invest my money in very specific assets. They're very alternative. I won't find them. They're probably illiquid. You're actively involved, and you're going to make sure that this investment is good. You're doing a lot of research, a lot of due diligence. It's more concentrated. It's not going to be 500 stocks. It's probably going to be less than 50 investments. And then 2, they're performance driven. So they have a 20% carry. They're going to take a portion of those profits over a certain hurdle rate. So they're really incentivized to drive returns. And most mutual fund managers, most wealth managers, financial advisors aren't focused on that. If they have zero incentive for you to outperform the market, that is a huge red flag when it comes to investing. That's something you need to think about. Performance fees and management fees when it comes to investing.